Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach, and today we have with us John Briggs, who's the founder of Incite Tax and Accounting. John, welcome to the program.
Thanks for having me, Mike.
Hey, I'm looking forward to talking with you because as we all know that there's always the holes in the proverbial bucket when you pour in revenue. Sometimes in some ways it's going to pour out the back end. So we want to learn how to mitigate as much as possible. Now, I know you can't ever eliminate, but mitigate, I know that's a great word. So we'll jump into that. But first, give us a little bit of your background and what your entrepreneurial journey has been like to this point in your career.
Yeah, so I actually went to a pretty conservative university, meaning they taught us and trained us to be employees. And when I graduated, I took a job as a controller, and come to find out that job, the company did $30 million in revenue the same year it declared bankruptcy.
Wow.
So this whole idea of job security really shattered my mind. So I'm thinking, a company that does $30 million, you would think that's a secure job. That's what I was taught. Just work for a company. And so at that point, I kind of felt like I would prefer to take control over my life. And, you know, in some realm or way to think about it is wake up every day unemployed and try to find a way to serve others. And so that started me down the route of my own accounting firm. And then my inability to say no to new clients led me to need to hire more people. And then from there, I mean, really just it's kind of snowballed. Right now, our accounting firm, we have about 35 team members, and we continue to grow year over year, even during some of the really bad years that people have had over the last couple of years.
That is awesome, and I love that first example about $30 million. Yahoo! That would put us on all kinds of whatever, Inc. 5000 or whatever, but then all of a sudden, what were you left with? And, you know, you see that same question come up time and time again on Shark Tank. And it's like, oh, well, if you made that much in revenue, what was your profit? We lost. And you're losing every year. And so really, what are you rejoicing about with 30 million or 10 million or 2 million or whatever it is? But if you can make, 500,000 and retain 200,000, come on, that's awesome. So when you're working with a business, what typically are you working with them on? Because I know you're an accounting firm, but you probably do much more than that and get more into like the planning as well.
Yeah, we always look at cash flow. Cash is king. And to your point, this company that I worked at, they were 88th on the Inc. 500 list.
Wow.
88th fastest growing company in the world. And Inc. is over here celebrating fast growth, fast revenue growth. That's all we're interested in. And they went bankrupt. After that moment, I've always thought, I wish someone would do a follow-up study every year on the Inc. 500 companies and see how many of them are still in business or how many of them are required to continue to get seed money and funding. Because to your point, I would rather have a much smaller business, simpler to manage, and my take-home is a lot higher. Because, so when we work with clients, revenue growth is great, but if we don't have any boundaries around it, most times revenue and expenses grow at the same pace, and sometimes expenses increase faster than revenue.
Yes.
And so we like to focus on a cash flow management system called Profit First, where you set boundaries around revenue growth and you're having different buckets with different responsibilities. We can get into that if you want. But the idea being, as revenue grows, the cash flow management system we use is based on percentages. And so we can sock away percentages of that revenue so that we know it's kind of earmarked for other things later down the road so that we're not spending $35 million in expenses when we have only $30 million in revenue.
Yeah, because then, where does the extra $5 million come from? Well, now that's where you come into, you're either borrowing from some accounts or having a big old line of credit or something, and that's debt. And now that amplifies the problem, because if it's debt to close the gap, well, now you got to pay debt service on that debt. So that makes it even worse. So, when you have a new client that contacts you guys, and what are they typically contacting you for? Is it simply, hey, you got to do some accounting, bookkeeping, or is it more of the strategy side? Like, where do I plug these holes?
Yeah, that's a great question. And I mean, we're large enough that we actually get, I mean, that's one of the benefits of the way we've set up our company is we have a variety of revenue streams. We have tax compliance where we do the filing. We have tax strategy. We have bookkeeping. We do the cash flow management stuff. So when one person expresses interest in one of those services, we obviously let them know that, running a business, it's not just one component. It's like, oh, great, I have a great tax strategy. Okay, but your cash flow management kind of stinks over here. Or I have impeccable books. Okay, but you're paying out the wazoo in taxes.
Yeah.
And so it's good for us that all of our services complement each other. But I think if I were to say generally, most people contact us for what they feel is their immediate short-term pain point, which is typically related around compliance, or like, I feel like I'm overpaying in taxes, or my books aren't clean, I can't make good decisions. Very rarely do they contact us specifically because the owner's dialed in enough to know that they need help managing their cash.
Yeah. Yeah, because they think if you were to survey 10 owners right now, let's wave a magic wand, get them on the phone and say, okay, do you have a cash flow problem? They're like, no. Oh, no. We've got money flowing, but it's flowing in and then flowing right back out. So, let's define.
Revenue's great.
Yeah, right. Cash flow's good. Yeah, but it's flowing in. That's in their mind. They're like, check that box, cash flow, but it's flowing right back out. Let's talk about that. So, yeah, that's a good point, is they don't know what they don't know. And, when you have to educate someone on the problem that they don't know exists. Now, in your case, it's really easy because it's like, let me just show you here, this a series of documents you just showed me, your financials. Look at that line item right there. Look at this piece right there. So it's easy for you to do that, as opposed to like, hey, well, if ever a meteor strikes, then we can. Hard numbers are hard numbers. So what do you do when you're talking to someone that comes to you for one of those other services, but you're looking things over and you're like, and it's screaming, they need help with this? How do you gently kind of shift over and go, hey, look, you came to me for this, little paper cut, but you've got an arterial bleed over here?
So it depends obviously on what their financials are actually telling us, but sometimes we like to use questions. For me personally, questions help me slow things down and really look for the reason behind the question. And so sometimes we'll just say, okay, looks like, last year on your taxes, you owed $20,000 or $10,000. How did you feel when you got that bill, and did you have the cash already set aside? And usually it's like, no, because I didn't even know I made that much money. And then I fought with my accountant, like, there's no way I owe that much in taxes. And so I had to, we went through everything, and it turns out I actually did owe that much money in taxes. Or they'll come to us and, we ask, well, it looks like you have a team. How easy is it for you to make payroll every month, or do you get stressed out? And are you on payroll? When do you choose to pay yourself? And usually the answer is, well, I'm hoping there's money left over after I pay all my bills and pay my team. But yeah, I'm stressed out. They get stressed out about paying their team members. And so those are triggers for us to say, well, and we walk them through. The first thing that we explain to them is they're normal, and this is a common problem. They shouldn't be embarrassed about it. But what's happened is they're falling prey to this rule called Parkinson's Law, which is kind of what we've already illustrated in story format with this company that did $30 million. But so Parkinson's Law states the demand for something expands to match the supply. And so the easier way to think about that is most businesses have one business bank account. Well, you have cash in that bank account. Think of that as a pile of supply. Well, the demand to use that cash available is going to continue to increase until you've spent all the money. And that's just natural human tendency. And so we say, so we're not going to try to change our DNA structure that's existed for thousands of years. What we're going to do is put some protection around it, and we're going to create a false sense of reality that we have less money to spend than we really do. So when revenue comes in, I'm going to take 7 to 10% of it, and I'm going to stick it in an account I'm going to save that for taxes. And I'm going to put 10% in an account to make sure as an owner I get paid. And then, I'm also taking risk as the owner that my team isn't. Well, in the stock market and Wall Street, they call that return on investment, and it's a very big deal to them. So let's set aside some money so that you're paying yourself a quarterly dividend so that you're rewarding yourself for taking the risk of ownership. And then from there, there's other ways to do it, but the common way is just say, well, let's just use now the money that's left over. That's what you can operate your business on. And now that we're still falling under this rule of like, look, the demand to spend that cash is going to be there as long as there's cash available to spend. But now I only have 65% of my money in my operating expense account, or 55%. And when that 55% is gone, look, it's gone, but I still have money to pay myself. I'm still going to give myself a quarterly distribution. I have money to cover taxes when that's owed once a year. And so that's kind of the simple framework of how we get into the conversation with clients. And usually it clicks for them and they think, they can think of 5 or 6 experiences they had probably in the last week where they spent money just because there's money in the account.
Well, and you know what? What you just said there reminds me of 2 books. Are you a book reader?
I love books.
Okay, so here's 2 good ones. You've either probably already read them, or it'd be like, ooh, that's cool. So how about David Bach, The Automatic Millionaire? So I don't know, it was written 10, 15 years ago, but one of the things that stands out from that book in my memory, which is what you just said, he goes, hey, if you want to have your money accumulate and over time and compound interest, all that, you want to make sure that you take money out before you can touch it. So it's kind of like, if you work at a job, you have them take it out of your paycheck, put it into, some retirement account. That's what you just said. So if you can take it out of the business and put it in something really quick before you can even see it, touch it, feel it, and feel like, oh, well, now we can do that corporate, retreat thing. Well, maybe we can do a corporate retreat, but not as extravagant as what we thought because we've already taken care of those things automatically. And then the second book is The Richest Man in Babylon. Have you ever read that one?
Oh, love that one. That's a classic.
And it's just the simple thing of 10% to long. This is what I teach my kids is 10% to long-term savings. For them, is college tuition, and then later on it'll be long-term retirement savings, and then 10% to giving charitable causes, and then use the rest. Well, that's exactly what you just said. If you can set up a business to take care of those, non-negotiables, if you want to think of them as that, and make sure the business is going to run. Well, then when you have that 55 or 60% number, whatever that is, now maybe you don't go to that one certain trade show that's going to cost so much because, really when you peel the layers back, it really is not that beneficial anyway. Or maybe you can't do that other thing or whatever. But I just think that is a light bulb moment for a lot of businesses to go through that thought process.
And what you just said, that is one of the most critical components of why this method works, is that now that you are only basically using 65 or 55% of the money to spend money to run your business, you need to go, most business owners have to go back and look at their expenses and realize you have unproductive expenses.
Yeah.
A lot of times business owners will meet with accountants, and accountants jump to this, I think, a mistake of saying, well, let's help you understand what variable costs are and fixed costs, because the variable costs are going to change as your revenue changes, but your fixed costs are going to exist forever. I think that's one of the most useless waste of time for business owners to spend time on those things. I think they need the 2 categories of expenses they should focus on is this productive or is this not productive? And like you said, the trade show thing. So if I'm running this system and I only have, $15,000 in the account when it comes time to sign up for this trade show, it's going to force me to look at what has my return on investment been in the past. And a lot of times I guarantee everyone listening to this has some expenses that they can cut immediately. For most of our clients, we set the goal of 10% off the top because usually if they haven't looked at it at all, there's at least 10% of expenses that are just they're habitual, and we haven't taken the time to realize they're not doing anything for us.
Yes, and just doing the return on investment calculation. I know numbers don't lie, and that's such a basic thing is to say, ROI. But one thing that I would say is from the strategic approach, sometimes you need to factor in CLTV to ROI. So the customer lifetime value to ROI. So maybe you run the numbers and it's like, man, we're going to invest X and we're going to typically only get this much out of it. And so it's not an obvious ROI right away, but we know that when we land this many new transactions or clients, that these people are just in forever and they refer and they stay. Now it kind of helps frame up the investment in those next funds. So I think that's a great way. You guys aren't just going, okay, tax return next, or here's your bookkeeping, here you go. You're looking at it through the eyes of how, while we're in here, it's kind of like, we're doing a tune-up on your car, and while we're in here, may as well change the oil filter because we noticed that's all messed up.
Yeah, and let me add something to the cost of, or the lifetime value of a client conversation. We for sure, as an owner, we need to understand, if depending on our business, we could have that client for 4 to 5 years or however long you figured out. And that's important. I do see companies sometimes make the mistake and say, well, our average client's with us for 10 years, so we're able to spend this much money on acquiring that client. But what happens is if they then add too many clients too quickly, they've been looking at it from the standpoint of, well, I break even on my investment in this client in year 2 or year 3. And if you grow too fast and you don't have the surplus cash flow in your other revenue to cover that. So I have seen clients grow themselves into bankruptcy because the way they looked at the lifetime value, they weren't anticipating the investment time period until they, get the money back.
I really love that because it really is like, well, let's stay with us for this long and refer in this, but it might take you 2 to 3 years to get to that point, and you're having to fund and pay your advertising and marketing and staff before that hits, and it's kind of like, we're almost there, but we can't make it. Then it's back to that $30 million a year company that went bankrupt that year. They might have had all kinds of CLTV calculations going. It's coming. The ship's coming in, but we didn't have enough cash flow properly structured to wait for that. Now, maybe your margins are crazy thin. You're still turning a profit at some thin margin, but you're paying the bills. And then now when that CLTV, hits, now it's like, boom, that year the margins are monstrous because we started getting those returns. So it really, it sounds as simplistic to say, but man, you got to know what's coming in and what's going out, and always keep an eye to where, is this expense or this activity, the best and highest use of time, money? Is it going to return? And I don't know. I guess one thing you said a few minutes ago has always made me wonder this when I hear it and when I see it on Shark Tank. And they're like, oh, good, you did this much in revenue, and you've been in the business 4 years, and you're not paying yourself. And my question is, how is that person who has, spouse and kids and house, how are they paying their bills? If they're not, quote unquote, paying themselves, how do their bills get paid? Because you can't really take money from the business and pay a mortgage payment because now that's cross, whatever.
Yeah, and if there's not cash left over, profit left over, you can't actually, there's nothing to even distribute to yourself.
So what in the world? We haven't started paying myself yet. Well, how are you living?
They're not. And what they're not realizing, so a lot of times we see in those scenarios that the business owner actually has a second job, or the spouse has a really great job that's funding it. And I always try to get, like, when I see that, I'm like, okay, well, maybe we should meet the two of us, you, the business owner, and then the spouse, and let's just make sure we're on the same page so that we're realizing spouse's income is actually covering your loss over here and your mismanagement of cash. And maybe if you knew that they knew, you might hold yourself a little bit more accountable for some of your expense decisions. Other than that, loans and credit card bills, where they're paying business expenses on credit cards, which effectively, if we really look at it, they're putting their lifestyle on the credit card.
Yes.
or they're taking a business loan and distributing to themselves to pay for their lifestyle. Either way, they're on borrowed money. And as we already talked about, there's a burden of servicing that debt, which then kind of cuts back into cash flow, and you can easily get down a really slippery slope.
It's a false representation of the actual numbers in the business. Because you're propping things up with external things like loans or lines of credit or personal this or that. It's not a standard, you're funding it through sources that aren't sustainable. And so that's a huge piece. Well, listen, I just love your mindset and how you think, John, and it's really great to see that you guys are taking that approach. So if someone listening to this is interested in minimizing their tax and, accelerating their existing cash this year, what's the best way that they can reach out and connect with you? So
if they go to our website, incitetax.com, and that's like to incite a riot, so it's INCITE, TAX, incitetax.com/wealth. We actually have a bunch of free resources there. And one of those resources, we have 9 questions that we encourage owners to ask about every single expense. And I know 9 on one expense seems a little overkill, but it really gives you a great angle. And if you answer all those 9 questions, you for sure will know by the end of the 9 if that's a productive expense or not a productive expense. And so that's just a free resource there. So if they want to go to incitetax.com/wealth, that would probably be the best way to get some stuff from us.
Excellent. Well, John, thank you so much for coming on. It was a real pleasure to talk with you today.
Yeah, thanks for having me, Mike.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneursradio.com.